So, learning objective 4 in chapter 5 is going to introduce you to something that I find exceptionally exciting, and I really hope that you will too. It's something called a multi step income statement, and I think you're going to like it. I think you're going to like it. We are going to need to prepare the multi step income statement in this learning objective. But I think you'll enjoy the information you actually get from a multi-step income statement compared to what we've been using so far. It also introduces you to something called comprehensive income. I'm just going to do it as an introduction and leave it at that. But the multi-step income statement is really critical. So what you have really kind of been exposed to so far is simply a single step income statement. The total revenues are listed, total expenses are listed, and boom, there's a subtraction. Okay. And so this form is extremely simple. It's very, very easy to read, but it's not really giving you a full picture of everything that the multi-step income statement will show you. So here is a single step income statement for the corporation that's part of your book here, Recreational Equipment Incorporated, or REI. This is it's a company like Dick's Sporting Goods, Modell's, Cabela's, that type of a sporting goods store, outdoors plus sports. And so that's what they are. They don't have, I don't think they have any stores in this area. I've been in one up in the Boston metropolitan area, but I haven't really seen them around much in this area. So here is a single step statement showing your revenues are listed first, expenses are listed second, and your net income is listed at the bottom. What you have here is two fiscal periods. The first fiscal period in this column ended December 28th of 2013. The next fiscal period, the very next year, started obviously December 29th, 2013, but didn't end until January 3rd, 2015. So it kind of ended a week later than we would normally see. And so you have the revenues listed first, side to side, the expenses listed side to side, and their profit for each of these particular fiscal years are listed here. So a couple of things to note that are important. One is the income statement is listed in thousands, which means that you have to literally add 3 zeros to every number to get the real number. So this might look like 2,017,476, when in fact, when you add the 3 zeros, it becomes 2,017,476,000. So sales, and again, look at this, it's net sales, not just sales, but net sales. And I told you that you're gonna see that over and over and over again. The net sales here went from 2 billion in this fiscal year to more than 2.2 billion. So it actually jumped about 10%, which for retail is really good. Any type of increase in sales to that degree, excuse me, represents a pretty good amount of growth. And so that's a good thing for this particular store. The next is revenue. And I think you need to understand one thing. When you look at any merchandising business, any retail stores, income statements, the largest expense that they will have is the cost of their goods sold, their cost of their inventory. Because remember, as we know from last class, they have to purchase all the goods and put them in the store, and then they resell those to us. So that cost starts off as inventory, which is an asset, but when they sell it, it goes to cost of goods sold. So as you see, because these are merchandising companies, they live and die by inventory. That's the whole purpose of existence. And so it should be no huge surprise that their inventory or cost of goods sold is the largest expense that they have. And that's true across the board. Now, this might also explain to you why company started way back in the 80s, and it certainly accelerated in the 90s through today. They started purchasing more and more of their inventory from places like China, and because they were able to get lower costs to their inventory by purchasing certain amounts from places like China. Walmart was really uh, quite a leader in this area of encouraging the outsourcing of manufacturing products to places like China, because Walmart's the largest retailer, not just in this country, but in the world. You can arguably in the world. And so they're the largest purchaser of inventory of various goods. And so they have a say. They have a say. And their say is lower the cost of those goods for us. Because just like any other retailer, the cost of those goods is their biggest expense. Remember, these are expenses. Expenses need to be controlled and need to be limited. And so a lot of what you've seen happen over our lifetime has been this emphasis on, particularly in the merchandising area, has been this emphasis on lowering the cost of inventory, thus lowering the cost of goods sold. The smaller this expense, the bigger the profit. So there's a lot of emphasis. Labor costs are a much smaller cost than inventory, but it is their second largest cost, okay, involved. So, and this is true again across the merchandising industry. Labor costs are significant, and but not as significant as the inventory. So again, they try to limit the amount of labor costs they have. So places like a Walmart have a structure where they would really just prefer to have a bunch of managers that they pay a certain salary and they work to death, and just a bunch of other people that they pay for part-time hours at, basically minimum wage or so. It's a deliberate structure to keep the cost of labor down. Okay. And speaking of labor, labor unions have been trying for almost 30 years, at least 25 plus years now, to try to unionize workforces, retail workers at Walmart. And they failed because Walmart is exceptionally nimble at getting rid of people that talk about unions. Um, and they've been very successful at that strategy so far. Again, they have reason to try to root some of these things out, which is their own bottom line. They're the profit for the business. So once you compare your revenues to your expenses, you'll have your profit or your net income here. So this particular company went from a very meager profit of 18, again, you got to add three zeros, 18,800 something thousand, to over $44 million the following year. So it more than doubled its profit. So that's a very good sign year to year. Okay, that's something that's important to note on this case. But notice that this particular income statement doesn't really give you anything other than the revenues up front, all your expenses together, and your net income. There's no additional information. You gotta be digging for some stuff here. The multi-step income statement gives us a little bit more of a breakdown, and thus we can look at a few things. So some of the highlights that the multi-step income statement does is it actually does calculate the gross profit for us. And as you know, gross profit is the sales revenue minus the cost of goods sold. And that's very, very important because the sales revenue is what they're collecting from the customers for those products. And the cost of goods sold is what they paid for those products. And so the difference is that gross profit. And that's important. They want a decent gross profit, clearly, because that gross profit has to pay for everything else. and leave them with a net profit. They also, so this is one of the most first things that they tell you. What's really interesting that you'll know here, we'll spend some time on it, is remember the word income means profit, right, or earnings. Um, they actually show you the profit just from operating the main business, and we'll talk a little bit about what that means. The main business for, I hate to go back to Walmart, but here we go. The main business for Walmart is selling goods. But as you know, when you walk into the Walmart here, well, in Fishkill, close by, one of the first things you'll notice is there's a McDonald's in there. I think there's also a hair salon of sorts in there. Um, well, that means that Walmart just isn't selling goods. That's their main business. But clearly, they're also a landlord. They actually are renting space in their buildings to other businesses, be it McDonald's or hair salons or banks or other, right? So that means they have other things that they're doing that they make money at, and they also have other expenses because if you're a landlord, you've got expenses as well. So what this multi-step income statement does is separate that. It tells you, look, if you're just looking at the sole operation of the main business, which is selling the products, this is their profit from that. This is their profit from that. And then they break that out into something called an other category. And they show you the other stuff that they're doing separately. And then they'll tell you, well, this is the net income after you look at all this other stuff. So it's actually quite a nice breakdown because it really provides you with more information. Your book calls them highlights, but more information about how the company is doing. So let's take a look. This is Recreational Equipment Inc., the same company we looked at earlier in the single step, but now this is the multi-step version. And these are the lines, right? First thing they talk about is they break out the gross profit for you. So again, these are the exact same numbers from the previous slide, and it's in your book as well. Sales minus cost of goods sold gives you the gross profit. So here you see they actually give you what the gross profit is for each of those years. Okay. Then they take away all of the operating expenses of running the stores. So REI, again, sells recreational equipment, right? Outdoors and sports type equipment. Are those stores profitable if you just look at the main operation of the company? And it is. It's highly profitable. It went from 129, almost $130 million profit to almost $182 million profit. This is this is a big jump in profits just by running the store, just by running the stores. But when you look at all the other stuff that this business does, you'll notice that this section is very important because now you know that businesses can earn other revenue. Like I said, Walmart charges rent to the McDonald's, to the hair salon, to the banks, whatever's in their big stores, and they collect rent revenue. Rent revenue is not selling their products. Rent revenue is other things that they do. Okay. So other revenue and gains are listed here. This company has none. But they also have other expenses. It looks like they actually provide what's called a patronage refund. I don't know what this particular thing is. I'd have to read their report. But as you see, this patronage in refunds suck up a large part of the profit. They're taking that out. They're taking it out and giving it to whatever patronages they have there, right? God knows. So that sucks up a lot of the profit from operating the store, right? That leaves them with a much smaller profit before they assess their income tax expense. After their income tax expense, they have your net income here. So, the company is more profitable than the $44 million that it shows. This is a very profitable business if you just look at it here. What this is going to determine in my book whether that's a reasonable type of cost that this company has. And again, I don't know exactly what they mean by patronage refund without reading their annual report. which will explain it. But if it's a damn good reason, I'd still say the company is very profitable and doing well. But it doesn't give me as much information as just purely looking at how the stores are doing. So you'll be actually setting up one of these in brief. Here is the one for PW Audio. PW Audio, again, it starts with net sales, but in order to get to net sales, right, you know how it goes from the last part of the chapter. You have your sales revenue, you subtract out your returns and allowances and your discounts to get your net sales. So you have to know how net sales are calculated because that is important, right? Then from the net sales, you subtract your cost of goods sold and you have your gross profit. So the gross profit, the difference between the net sales and the cost of goods sold. Then all the operating expenses for running the main business PW Audio does, selling that merchandise that they sold. That provides them with a profit from their operations of $30,000, as you see here. Okay. But then they obviously do some other stuff, okay, because they have other revenues and gains, which would be added, and other expenses and losses, which would be subtracted, right? So it looks as though they have some interest revenue and a gain on plant assets for $3,600 gain that would be added. But it looks like they have a big interest expense and a loss to report that totaled about $2,000. So, so basically now their income before they do their tax has actually increased from $30,000 to $31,600. So this is actually somewhat enriched because this is how the business is doing, purely looking at the business. I mean, what it does, the core area of selling their audio supply stuff. But obviously they do other stuff, which is more making the company a little bit more profitable. I mean, not much more profitable, but more profitable, right? And boosting their profit before they take away their income tax expense. They subtract out their income tax expense and they have a profit of $21,500. But maybe without this increase, that profit would be a little bit smaller, right? Would be closer to 20,000 because they got that little boost from the other stuff that they do. Okay, so this is an important part of MultiStep. The other activities are basically explained to you in the book as well. This is all there in the book, telling you what some of these non-operating activities are. Again, things that the business is engaged in that either makes money or loses money, but is not related to the main purpose of the business, which is selling their goods. Okay. So this is very interesting, no doubt. And then the next thing that they introduce you to is something called comprehensive income. Comprehensive income is the net income from the income statement that we just saw, plus or minus any what we call unrealized gains or losses. So these are basically book losses or book gains. They're unrealized because they haven't really happened yet. And so it sort of boosts their entire what we call a comprehensive income. Okay, so these are not determined on the of what net income is because these are somewhat paper gains and paper losses. They're not necessarily real. Okay, but they need to be reported if the company is putting together a comprehensive income statement. Okay. Again, I'm not going to emphasize this very much. I just wanted to introduce to you what it is because you'll see it and you should know what it is. So the do it exercise for this particular part of the chapter is preparing that multi-step income statement. Okay. This particular company is the Art Center Corporation, and it had a year that ended December 31st of 2017. It's going to ask you to prepare the multi-step income statement. And once you have that, can you tell us what the comprehensive income would be? Because they did give you this other piece of information specifically for that. But all the rest of it here is for your multi-step income statement. Okay. So multi-step income statements are like any other income statements. They start with revenue. But in this case, they give you sales revenue and they also give you sales discounts. So you're going to have to subtract the sales discounts away to get net sales, right? From your net sales, you subtract out your cost of goods sold. That gives you your gross profit. From your gross profit, you subtract out your operating expenses. That gives you your income from operations. From your income from operations, you add the other revenues and gains and subtract your other expenses and losses. And that gives you your profit before taxes. In this case, you're estimating that 25% of that profit is going to be taxed. So it's going to be a tax expense, and the rest is your net income. That's how you explain it. This is how it looks. Okay. So for the multi-step income statement, you have to calculate net sales, which means sales revenue minus, there's no sales returns and allowances, but there are sales discounts. So you subtract that out. Net sales minus cost of goods sold, here's your gross profit, right? Gross profit minus operating expenses, there's your income from your operation, your profit from operations. Then you have to take all the other stuff into consideration. You're adding 8,000, but taking away 3,000. So you're actually boosting the total by 5. That's your profit before your income tax. Income tax is 25% of that. So you put an income tax expense together. That leaves you with your net income. From your net income, you simply add any comprehensive income that has been reported for the comprehensive income statement, which basically is that $10,000, let me go back. This $10,000 other comprehensive income would be added, but that's also subject to tax. Okay. And so $10,000, 25, excuse me, good Lord. Woo! $2,500 tax taken away from that would add an additional $7,500 of income. And so the total comprehensive income would be $92,250. So this is something that you're going to have to do for this particular chapter. But this, you can see that the multi-step income statement just gives you, I think, a good amount of information that you wouldn't ordinarily get by looking at an income statement.